All right, thanks, Matt. Again, thanks to you guys for coming. For a lot of you, it's a pretty good little trip, especially up my way. So I appreciate you making the drive and getting up early and having at it. So appreciate that. For the last month, I've been waiting to do this. I couldn't wait. This is Barry Ward from the Ohio State University. So I've been waiting all month to do this. The Ohio State University. College.
There's only one.
College of Food. I wrote all this down. He's got a really good bio. College of Food and Ag Environmental Sciences. He's the lead on production business management. He works collaboratively for the development and delivery of extension programs. A lot of you guys already know that from the Ohio side. It provides managers and farm ag business with tools, information, analysis to manage their farms. His focus is land economics, farmland value, cash rent rates, farmland lease issues, crop economics, budgets, machinery economics, and tax. Just what we want to talk about today. Man, listen to that load right there. Makes your head hurt just listening to that list right there.
Thanks.
He's the director of the OSU Income Tax School. Can you imagine that? Can you imagine? Plans, organizes, co-teaches the schools for tax professionals, as well as providing tax education on critical issues for Ohio's ag sector, which is really critical. Also some undergrad instruction. He does the farm business management class. I couldn't imagine doing that either. That's a doozy. And he also farms with Ward Farms, small farm in Urbana. So glad to hear that too. So Barry, thanks for coming.
All right.
Appreciate it.
Thanks a lot, Doug. Thank you, Matt. It is my pleasure to be here. And amongst all you good folks from both sides of the state line, I wasn't sure exactly where I was. My GPS informed me that I was in Indiana, and then I think I went back out of Indiana for a little bit. It was right down the border. I talked with a few folks already about athletics. I'm not going to talk too much because Ohio State just got their rears handed to them by the Hoosiers. But we're in one of those areas that is difficult, right? We've got probably some Purdue fans, some Hoosier fans, a lot of Ohio State fans on that side of the border, UD fans. Cincinnati, Louisville, I don't know what all the allegiances are here, but perhaps we could agree that we were all at least Bengals fans over the last couple of days, and we're hurting from that particular defeat. Okay, enough on sports, right? We're gonna talk about a number of things, and as Doug talked about, I've got a number of different things that I'm responsible for. One is taxes and tax education through our university and through our college, and part of what I do is we update practitioners. So practitioners, those people that are filing most of your taxes, they have to be updated each year and they have to have continuing education. So we do that work. And I've saved the best for last as we go through this, and we're going to talk a little bit about taxes towards the end. So I'm not going to put you to sleep right up front. A number of things. Okay, we're going to talk about kind of big picture issues. The Fed's going to make a decision here later today that's going to impact us. We're going to look at some select input costs, kind of a big picture of what our crop budgets are going to look like for this upcoming year. And your numbers are going to look a little different, but at least we're going to kind of zero in on overall what that bottom line might look like. We're going to talk about land values. Okay, my data is going to be mostly Ohio. I apologize those folks here in Indiana, but I'm going to show a little bit of information that I think is going to be probably an overview that's going to be meaningful for both. And we're going to look at that rental market. And then I'm going to have a little comment or a few comments on lease strategies. That's probably one of the number one things that you're wrestling with right now, especially those that have a number of landlords, is how to go about this lease negotiation. I don't have any silver bullets, okay? But I am going to talk a little bit about some flex lease arrangements that you might consider. Okay, it's a little bit of feedback, right? So I'm going to try to lower that down. All right. I don't want to get in front of this for anybody, so I'm going to kind of wander around here. Okay, so let's take a look first of all at some of the big picture items. Inflation, we can't ignore that right out of the gate. It's impacted us, overall the general inflation of the country, and we look at the global inflationary numbers, they're also very high, but also, drilling down to the farm level, there's some key things that have impacted us. All right, the textbook definition is too many dollars chasing too few goods. I do teach a class on campus, as Doug mentioned, farm business management. That's for juniors and seniors, and it's a different challenge after COVID as opposed to pre-COVID. Students have a different mindset, so kind of dragging them back into the classroom and getting them to think about, I really have to come to class now every day. That's, for most students, it's okay, but there's a handful. Boy, it's a challenge. Anyway, we've talked about this just recently, inflation, too many dollars chasing too few goods. We've had lots of different stimulus packages going all the way back to COVID and then beyond. So a lot of money in the system, and then we had COVID-related hangover, right? All of these supply chain issues. Are we sick of hearing about supply chain issues? Yes. Okay, then the Fed responds, and we're going to talk a little bit about how the Federal Reserve Bank, our institution, our national bank, how they, one of their mandates is to control inflation. And that's what they've been trying to do over the last year. We're going to talk about the dollar, the rise and fall, quote unquote, of the dollar. All right, the CPI. Typically what we look at in the press, the headline information is the Consumer Price Index, just a measure of inflation. It's been high, right? We know that. Okay. Moving on, we look at the Personal Consumption Index. This is actually a little bit more important as the Fed tries to make their decisions on increasing or decreasing their interest rates. And I know that's kind of, as we talk about the Fed activity, and some of you follow this very closely, some of you probably not so much, but it does have a direct bearing on how much we pay in interest for our lines of credit, farm machinery, farmland, all of these things that impact us as producers. It's meaningful. So they get their direction mostly through this particular inflation number, this PCE. And you can see in September it was around 6.3% year over year inflation. In December it moderated down to 5%. So this direction of inflation is important as the Fed considers what to do this afternoon, okay, as they make their next move on controlling inflation, but trying to balance that against what? Really not pushing us into slower growth or recession. So they're trying to balance that, and they have that preference for this data set, so you can pay attention to that. Okay, here's a history lesson. Many of you lived through this. Some of you have vague memories of it. Going back here, this goes back all the way to 1955, and the Fed rate, the effective rate, as they move interest rates up and down to either stimulate the economy, lower interest rates, or try to slow down the economy with higher interest rates. Okay, here's the farm crisis of the late 70s, early 80s. Some of you even paid some of these higher interest rates. There was persistent high inflation in the 70s, and one of the things that the Fed eventually had to do was institute this strict, harsh monetary policy, high interest rates to cool down the economy and lower inflation. They finally accomplished it. We went through some periods here. Here is the Great Recession. Fed rate close to zero. You paid lower interest rates, stimulate the economy. Things got a little bit better, and then boom, COVID. Right here at the very right-hand corner, some of you can't see it, they lowered interest rates again to stimulate the economy. And now at the very tail, you can see those interest rates have increased. Here are the Fed rate increases over the last year, okay? They started in March, kind of tentatively. There was still thinking that inflation was transitory. It was going to go away pretty quickly and easily. And then the Fed started to realize that it wasn't that kind of an inflationary period. So we had these, what they called kind of major increases of 0.75% for 4 periods, and then they started to slow down. The money, most of the money is probably on a 25 basis point increase or a 0.25% rate increase today, maybe 50 basis points. It's going to be, I think, Chair Powell has indicated that we have to go through some pain to start to control this inflation. And I think he's backed off of that a little bit, perhaps. I mean, I think they're seeing a path where we might not slip into recession. and still be able to control inflation. If we go back 2 or 3 months ago, I think that path looked unachievable. But right now, the expectation is we may be able to do it. Okay, the Fed's done two things. They've raised interest rates, and then they've started to allow their balance sheet to unwind. The Fed has increased their holdings, their balance sheet. We go back here, this is the Great Recession where they started to just take on more and more assets. They termed this quantitative easing. They couldn't lower interest rates enough. They could only lower it to between 0.25%. And beyond that, well, they were having trouble kickstarting the economy, so they started to add assets. So 2 different strategies, and now, after COVID, boom, they increased their assets again. Now we're starting to see them allow some of these assets to mature, roll off, and not be replaced. So those are the 2 things. Here's the December dot chart, and the thinking has changed since then. Okay, this is a mess and not easily understandable. This is the one I want you to pay attention to right here. This cluster of dots indicates the Fed governor's thinking as far as where interest rates would end up in 2023. Here's where we are now, between 4.25% and 4.5%. Their thinking was, at least the majority thought, another 75 basis points would be about where we would end up in 23. So another almost 1%, 0.75%, okay? I think some of that thinking is different now. I think when we see their dot chart come out after this set of meetings, we're going to see perhaps 0.5%. There's a lot of thinking that the Fed is going to maybe make a couple of rate increases in the first half of this year and then even start to look at unwinding or decreasing those interest rates, cutting towards the latter half of this year. We don't know yet. There's a lot of things that are going to have to happen before we start to see those rate cuts. Inflation is going to really need to show a downward trend closer to 2%. Okay, as I mentioned, Fed's it's a delicate maneuver, trying to decrease inflation, control inflation, and yet still have the economy see some growth. We don't know yet whether they're going to accomplish it. The third quarter, we had 3.2% GDP in the U.S. The early estimates are about 2.9% in the fourth quarter, and then that number's likely going to trend lower into the first and second quarters of this year, very likely. And then unemployment. One of the reasons why most economists aren't too worried about a severe recession is unemployment numbers are so low. Now this number is going to start to move higher. Unemployment numbers, we've seen lots of layoffs and job throughout the country. This number doesn't tell the whole story, as most of you know. 3.5% unemployment, that is just those folks that are seeking. And what we found post-COVID was there's structural change in the employment sector in the job market. This next number tells a little bit more of the story, labor force participation rate. So this is all of those people in the certain age range, including those folks that aren't seeking, okay? So we go back here and we look at really pre-Great Recession, if you will. This is that Great Recession period, as they term it. Labor force participation rate was around 66%. Never really recovered from that. And then we got here to COVID, and of course we had that real plummet, excuse me, in employment, and we are not yet recovered from that. All right, so there's a little slack in the system. There's different reasons for this. Some are just two worker households. Sorry, got something caught in my throat. Some of those folks just haven't gone back, or both of them haven't gone back to work. And then young people, that's also another part of this, not entering the job market as quickly as what they might have in the past. So there's some slack here. Probably we're going to see this number, both numbers trend a little bit lower. Of course, these numbers reflect non-farm employment numbers, okay? The farm sector is left out of this as far as farm employees, but it does give us some idea of what the overall economy might do. Okay, so what does it mean? All this discussion on the Fed what is it going to mean for us in terms of interest rates that we're going to pay? Here's all the interest rates together. This is that Fed rate that we looked at a little bit ago, the 10-year Treasury, oftentimes correlated with that. But it has another few set of factors that also influence that 10-year Treasury. And then also, here's the interest rates that we pay. Okay, so this is the 7th Fed District data right here, these two. They survey bankers in the 7th Fed District, which includes most of Indiana, Illinois, Iowa, parts of Wisconsin and Michigan. Not Ohio. Ohio's in the Cleveland Fed District, but the data is very representative of what's going on in Western Ohio. So you can see it's pretty highly correlated. Here's the data from that 7th Fed District as of the 3rd quarter. We don't have the 4th quarter data yet. July, September, they surveyed bankers, lines of credit, operating loans, about 6.5%. Is what those banks were charging. Now, since then, we've had a couple more rate increases. So this number is likely going to be probably another 0.5 to 1% higher for many of you. All right? Or it will be as we move into this next 0.25% increase that we expect today. There's always a lag, but it's about 2 percentage points higher than where it was the year before, and real estate loans just above 6%. So those interest rates, it's something we really haven't had to worry about for quite a while, is these higher interest rates that we have to pay on borrowing. And it just also affects our carrying charges. It should affect your thinking in terms of when you're going to take delivery on fuel and fertilizer and how long you're going to store it. Because the longer you pay for and store it, you're racking up, well, maybe invisible charges, but they're charges nonetheless. All right, questions, thoughts on interest rates? More than you wanted? Probably. Okay, we're going to keep on going. Okay, other input costs, fuel and fertilizer. This is the next two. Meaningful inputs, there's some good news and bad news as we look at inputs going into this growing season. Fuel is perhaps one of the good pieces of news, got softer numbers. A big reason for this, there has been some adjustment in demand globally due to these higher prices. Some supply has come back online or been expanded. But there's also this effect of, okay, we're expecting a little slower growth globally. So that's built into the modeling as we look forward into this year and try to determine what these energy prices are going to be. This is data from the Energy Information Administration. They're our national body, this agency that's tasked with modeling the energy markets. Okay, so we look at this is the West Texas Intermediate price, $77 a barrel. That's what their expectation is on average for this year. Lower than last year, still higher than the year before. So good news that we're trending lower, still above where we were a couple of years ago. The expectation on growth, 0.5% GDP for the whole year for the U.S. That's not great. And that number may be a little bit higher, and if that number ends up being a little bit higher, probably we're going to see these energy prices be a little bit higher than these expectations. Driving down here today, I was about 10 or 11 miles east of 127, right? And I saw gas on the highway 307, I think. It was the lowest I had seen between where I live and here. So good news. Diesel, I think the lowest price point I saw between here and home was around $4.25. That's highway diesel. So on-farm diesel, at least in Ohio, about 50 cents tax on that. So probably some of you are getting some wholesale brought into the farm for sub $4 perhaps, or you could right now. So those numbers are higher or lower, and that's a little bit more good news for us. Okay, so possibly some relief there. A lot of our inputs go up and down with corn price or commodity prices in general. Fertilizer is one of those that's fairly highly correlated. And until we really start to see corn price or soybean combination prices sink a little bit lower, we're likely not going to see tremendous moves in fertilizer prices. We have seen them soften the last couple of months, so that's been positive. We're going to talk about some of those fundamentals that have influenced those price moves and things that I think you should follow going forward. All right, this is just showing that correlation. This is Texas A&M study. This looks at corn price in red. All right, corn price in red, and then an adjusted anhydrous ammonia price. Okay, they pull out a certain section of that price, but you can see a pretty consistent correlation between corn price moves up and down and those fertilizer prices. In this case, it's nitrogen. Lately, okay, this is the DTN data. Some of you have access to this. This is the nitrogen price on a per pound of N basis. Softer, you all know this. I'm not going to spend any time here. You know, some of the reasons. Demand has been strong. High crop prices have led to this. However, over the last few months in the fall and into the winter, that demand has been shown to be a little, perhaps, less than what the expectations were. We went into the fall, that application window for most of the Midwest ended up being a little bit lower in terms of demand than the expectations. South America, that demand was flat in most cases. The Indian demand that typically comes this time of year, they did send out a tender. They buy a huge amount of urea on the global market, and that was, it was still substantial, but perhaps it wasn't as substantial as what some of the analysts were considering. So some of these demand pieces were a little softer than what we expected 6 months ago. That has led to a little lower price points for many of our crops, or many of our fertilizers. We had high natural gas prices in the fall, both here in the U.S. and more importantly, really in Europe, when we look at the fertilizer sector. That availability issue, that led to a number of fertilizer plants across Europe shutting down or really curtailing production. So I'll show you a few of those here in a moment. What we've seen since then, as we've moved into the early part of winter, these global natural gas prices have trended lower. Shipping costs have trended lower. Okay, as an example, we had one of the latest numbers that I've seen as far as moving a container from China to the U.S. $1,400. That's pre-COVID numbers, okay? So a lot of our shipping costs that were really high in 21 and part of 22, some of those supply chain issues have started to work themselves out. What do you think the top was in the early part of 21 to get that same shipping container from China to the U.S. West Coast? It was higher than $1,400, I'll tell you that. Anybody have a guess? Some of you may have read this. It was more than 5. It was around 20,000, yeah. It was a little over 20,000 at the peak. So that just gives you an idea of, and that's container cost. That's not bulk cost where most of our product goes and comes, but that at least is kind of a proxy to give you an idea as far as the differences. So shipping costs, we're seeing some relief there. These global natural gas prices have trended lower. Part of the reason, at least one of the main reasons, is overall in the Northern Hemisphere, we've had a fairly mild winter, both here in North America and in Europe. Now, we look back in those few days before Christmas, that was sub-zero and the wind chills were minus 30 or 40 in some of our areas. That didn't feel like we were going to go into a mild winter, but overall, it's been fairly mild. Natural gas is, heavily influenced by winter weather. Here are the prices. These aren't on the same graphs. I know you're sick of graphs probably already, but that's what we economists do. We throw up graphs. So right here is natural gas price, U.S. dollars per million metric BTUs. That's how they measure that. The Henry Hub down in Louisiana, price is trending lower. The European price following a similar trajectory. This is good news for us. It's good news for them because they were really concerned about whether or not they could make it through the winter without all that Russian natural gas. and I think they're going to come through pretty well. And at the same time, some of those nitrogen manufacturing plants that were idled have started to come back online. Okay, so that's good news for us, even though we don't get any European product. It just allows a larger global supply. You know, these prices tend to decrease because of that. Here's the comparison. If you want to do some comparisons, here's what we pay for natural gas at a wholesale level. This is a futures price. We're not ever going to get it for this as individual producers if we're buying natural gas. Here's the European price. Okay, so you can see they've got a number of other structural issues. They've got more regulation, but they also have this heavy reliance on Russian natural gas, which has largely been cut off, and that's increased those prices. Here's some, just a listing of some of these plants that have shut down, and some of these, again, have come back online. All right, trade issues. These are also impacting fertilizer. China has really curtailed their exports. We have continuing ongoing sanctions on Belarusian potash. Maybe you don't think about that too much, but it does influence the world market of potash. We get a lot of ours from Canada. Russian invasion and ongoing war against Ukraine. This just instability in that region does influence our global fertilizer prices. Russia has some export quotas as well. All right, U.S. dollar has continued to weaken, which is good for us as we export product. And exporting grain is part of what we do, right? So that's helpful often with grain markets, but on the buying side, you know, we don't get as much for our money, right? So this does, in some cases, hurt us in terms of that fertilizer that we import. The EU just recently here removed import duties on certain nitrogen fertilizers, which they had in place largely for environmental concerns, but with all the problems that they have, they've lifted those import duties, so that has allowed a little bit more stability in the global marketplace. And also this Black Sea Grain Initiative. All right, they're still at war, but they are allowing grain to be shipped out and fertilizer to move both ways in that region, as of the last I've checked. This UN-Turkey brokered deal between these two countries. Sometimes the world makes no sense. We're still firing at each other, but okay, pause, we're going to allow we're glad they're doing it, right? It does help. Well, perhaps not the grain market side. It does, they are a competitor, but I think we'll sacrifice that. The U.S. dollar has drifted lower. One other thing that we're going to deal with, many of you know this, you've followed it. Mosaic brought a suit a couple of years ago against certain manufacturers in two countries that they were illegally subsidizing and dumping phosphate fertilizers into the U.S. And really they were, but what ended up happening is that the U.S. International Trade Commission and the Department of Commerce ruled in favor of Mosaic and those other petitioners, and they slapped these tariffs, or what they call countervailing duties, on these companies from Morocco and Russia. So whenever you slap tariffs on somebody, whether it's an important country or not, it tends to raise the overall global price and our domestic price, probably. It's hard to sort out how much, but this probably is influencing a little bit phosphorus fertilizer prices that you're buying, that you're paying for. There was another suit that was brought by CF Industries on UAN products, nitrogen products out of Russia and Trinidad and Tobago. We actually source a lot of our nitrogen here in the U.S. out of Trinidad and the Caribbean. That suit, it was going through the process. It went through the U.S. International Trade Commission. It was eventually found to be without merit. It didn't have enough substantial evidence to support it, so that case was dismissed. So at least we don't have these countervailing duties on nitrogen products coming out of those two countries. All right. Here's one we can argue about, with all the industry consolidation in different sectors and different parts of the fertilizer industry. Did we see a lot of profit taking during this period of lots of volatility? Well, there's arguments to be had both ways. Did companies take advantage, take a little bit more of a cut as that thing moved up and now starting to move down? I would argue yes, but it's hard to sort this out. There's certain sectors, the potash sector, very few global players, a lot of market concentration, and that's where we start to get into areas of concern, where we have very few market players. All right, so what do we do about it? You know, there's lots of things. Many of you have already exhausted all the things that you can do. You probably have even cut some applications because of these high P&K costs. You know, more intensive soil sampling, grid, zone sampling, that's going to help your cause a little bit. I know it's a costly service, but in periods like this, it can really pay for itself. There's this nitrogen rate calculator. You know, Purdue and Ohio State both contributed to the data that went into this. It's housed at Iowa State University, but it does allow you to input your price of nitrogen and the price of corn, and it'll give you a return on that investment. It's a really cool tool. It's got some updated information, updated fertility information for both states. I'm happy to share, of course, all of these slides. Just send me an email, and I'll also share with Doug and Matt too. So just in case you missed something. And also if you have questions. I don't want to be up here like I'm lecturing to my class. All right. Here's the last one I'll point out that I'll just, you know, a risk management strategy, especially if you're concerned. Well, the big concern that I have is we get into a marketplace where we see grain prices fall into the spring and early summer, and fertilizer prices remain fairly sticky. So we've got all this high-priced fertilizer, and we've got grain prices that trend lower. I know these other gentlemen are going to talk about outlook on grain. I'm not even going to go there. But if you want to try to manage that risk, you can lock in some of that margin by combining some grain sales with those big bulk fertilizer purchases, locking in that margin, if you will. All right, overall then, this is a work in progress. And I actually have some surveys that anybody that's willing to share their seed cost on a average per unit basis, I would like that. We're plugging in about 5% higher seed costs. Diesel price, I just changed this the last couple of days, lower to $4 a gallon. Crop protection products, flat. Okay, I know that this is a mixed bag. Some products are going up, some are moving lower from last year. Fertilizer prices, this is what we're plugging into our budgets right now, $1,200 for ammonia. This is trending lower. I know there's a lot of sub $500 28 out there that can be had, especially if you got storage. 810, these potash prices are moving lower. Here's the big jolt. You know, we're plugging in 20% higher machinery and equipment and parts numbers. If you're going to replace and trading in, you're going to see, you know, a big effective depreciation cost. So I know, if you can excuse the scarlet and gray, sorry folks from Indiana that aren't Ohio State fans, this is our corn budget outlook for 23 as it stands right now. So we're plugging in about $5.70 a bushel. That's about where the December futures are, minus about 20-cent basis. I know this region of Ohio and Indiana, you guys have a little stronger basis than average typically. So the number is going to be a little bit better for you. Here's our trend yield for Ohio. Indiana is going to be a little bit better. Here's kind of a better scenario. So we've got two scenarios. Our costs aren't going to be yours, but it's going to get us in the ballpark. So our returns above variable costs, I know down here at the bottom, about 384 and 523 for a higher yield scenario. If we include all our costs, including paying ourselves about 90 bucks an acre, then we're seeing negative numbers for trendline yield. So even though the prospects don't look too bad, there's also still the possibility that we could slip into a loss if we're not careful and if we have poorer yields or prices than what we expect. Soybeans around 13.30. November futures are right around 13.60 as they closed, I think, yesterday or thereabouts. 57 bushel beans are 68. And then you can see the differences in terms of returns to variable costs down here at the bottom, or contribution margin for those that follow a lot of Purdue information. Wheat budget, no, 74 bushel may not seem like a lot for some of you that have good years, but that takes into account those bad years too, right? About 750 for July delivery. The numbers don't look so good, but this doesn't include any straw or double crop return, and the comparisons between the three. Corn at 570, beans at 1330, and I know these numbers, again, are a little conservative perhaps, but returns to variable costs right down here, returns to land. All right, so in other words, we're going to pay everything, all of our overhead, machinery and equipment depreciation ourselves, any other miscellaneous fixed costs. This is what we have left over to pay land rent or pay a payment if we're going to make a purchase. So if we look at this, soybeans, we're assuming this no-till soybean production. And I know some of you have moved back into conventional bean production, but so our overhead machinery and equipment costs are going to be a little bit lower for soybeans. So comparisons, this has fluctuated. Beans, we're looking far and ahead to better bet as of a couple of months ago, and then after the first of the year, beans were kind of in a free fall for most of January, right? And we got to the point where corn actually looked a little bit better in our comparison. Your yield, relative yields are going to be a little bit different. All right, so returns to land right now at least favor beans. All right, cropland values. This has been a runaway freight train, right? We've had a strong bull market in farmland values really for about the last 18 months. Now our survey data, and I don't have the Indiana data, I know Purdue has a similar survey that they do and I look at it all the time, and actually I shared this information with one of our retired professors that have farmland in Indiana just recently. So the numbers aren't too far off, but our survey this time last year of bankers and appraisers in Ohio, they were guessing farmland values were going to increase about 8 to 11%. And that number is wrong. It's, our guesstimate ended up being well under where we ended up being when the dust settled. Rents, we were expecting about 5.8 to 6.8% increase. I would say that's pretty close to where we ended up from 21 to 22. Okay, here's the 7th Fed District. Some of you follow this pretty closely. Again, this includes Indiana, not Ohio, but it's fairly representative. The Cleveland Fed District does not have any ag research arm. The 7th Fed District out of Chicago, they do. So this is useful for us as well, but it showed, and these are big numbers, but talking to some of our appraisal groups in Ohio last week, and we had the annual meeting of our Ohio chapter of the American Society of Farm Managers and Rural Appraisers. I'll share with you in a moment their data, but right here, year over year from October to October in Indiana, the lenders in that 7th Fed District that were surveyed indicated good farmland increased 29%. Probably not too shocking to many of you. For the entire 7th Fed District, 20%. A big year. Farmland values increased pretty dramatically. The numbers that our Farm Credit Mid-America folks, their appraisal arm, shared with me last week, they have certain farms that they monitor. They follow these year in and year out. They're benchmark farms. Okay, and they follow these, they give them an appraisal update, and they indicated from year to year, in January to January, their set of benchmark farms increased 34% in value, even higher than this number right here. So I would say throughout most of Indiana and Ohio, if we look back from 21 to 22, we probably saw 25 to 35% increase in farmland depending on the quality and also the region, right? Okay, big jumps. Here's this part of Ohio at least showing, average land, about 190 bushel corn ground, selling for about 11. That was the beginning of 22. All right, by the end of 22, I don't think you could have bought much average farmland in this corridor, especially for 11. There's some, and they're a pretty wide range, and renting for about 250. Better ground, 310, and that number, both of those numbers have increased as well. Lots of 3s and 4s in the better farmland, and I'm sure in this corridor too, on big productive parcels. Here's some additional data. One I'll point out here that might be important for you. Rent as a percent of land value, at least as our data. And this number has trended lower in the last couple of years, mainly because farmland has outpaced the rental market, around 2.3, 2.4%. Here's the NASS data, just the rental numbers on average We've got a couple of rebel counties here that didn't return enough data to USDA NASS to have their data published. We know why. It becomes public and it helps drive the market, right? And Indiana's got some similar data too. But you know, the important thing is trying to understand how this is going to sort out in the next year. Here's the big thing that's going to, I think, start to weigh on markets is interest rates. There's always a lag with interest rates and asset values. Part of the Fed's strategy is not only to, you know, slow down the overall economy, but it's also going to be slow down this appreciation of asset valuation. The stock market has, you know, seen this, right? They're hopeful that these interest rate increases aren't going to further, you know, they're hoping it's a 25 basis point move rather than a 50 basis point move. Is this going to be enough to offset still healthy net worth in the sector? That's really the big driver in farmland markets. Now, of course, there's investors. And in Ohio, we've got lots of solar activity, solar farms that are being proposed. That's also been a driver. And some other types of industry, you know, we've got Intel, we've got Honda that are making big footprint purchases that's causing 1031 money to kind of ripple out. And you guys in Indiana, you're probably seeing similar things. But the balance between still very healthy equity that's driving most of this increase in farmland values and these higher interest rates. I don't think we're going to see an increase like we did last year. It's impossible to sustain that level of change. I do expect to see farmland markets in both states increase. It's probably going to be more in the order of 10 to 15%, if I had to guess. Okay. Questions, comments on this? I'm going to talk about rental markets here in a moment. I'm not going to spend much time because this is my road speech, and I'm talking mostly to Ohio folks, so I talk about a couple of things in legislation change. Ohio House Bill 397, we now have a statutory termination date for firing your tenant, okay? So you have to do it in writing by September 1st, or they get another crack at that land. There's some other important points. I'm not going to go through these, but no, I'm not sure. Does Indiana have this on the books? Do you guys have a statutory termination date? Iowa and some other states have this. Ohio never has. And a couple of the attorneys I work with in the college have indicated that they're not real comfortable with this September 1st date, but that's what it is. So most of you in here, I guess all of you in here are farmers, and maybe you're also a landlord too. But if you're going to want to get rid of your tenant, you have to do it in writing. Okay, this includes oral leases and written leases that don't already have termination language. Around 50% of the leases still in Ohio, and I would guess Indiana is similar, are handshake oral agreements. Our attorneys would like to see that number higher, but it's still pretty low. So that's going to be one of those issues. Okay, next thing is we now have a beginning farmer tax credit. If you as a landlord are selling or leasing to a beginning farmer under $800,000 in net worth, less than 10 years of activity in farming, then you're going to get a 3.99% tax credit on your Ohio tax bill. All right, moving on. This is a salt cap workaround. Indiana, I think, has explored this. I'm not going to spend any time here, but this is more of a federal tax issue. So if you used to itemize your deductions on Schedule A, Tax Cuts and Jobs Act limited your state and local deductions to $10,000. This is a workaround for that allows you to take and apply your state taxes at your business entity level, so an LLC or an S Corp level. Okay? Yeah.
They just put that on the docket.
Did they? Okay. Yeah, there's 20-some states that have something similar. So, okay, so this just allows you, if you have a pass-through entity, an LLC for many of you, or partnership, or an S Corp, you can make the election to pay your state taxes at the entity level. The effect is you're going to have a less federal adjusted gross income, or a lower amount, flowing from that entity on a K-1 to each of you. That's the workaround. Okay? You just have a little lower federal adjusted gross income. So that's the substitute for writing or including that on your old itemization Schedule A. Most of us take the standard deduction now because it's $12,000 or $24,000 adjusted for inflation for single or couple. Just eliminates a lot of headaches. But this is a workaround to allow you to now kind of take advantage of those state taxes and write them off in effect. I'm not going to go into this. This is pretty specific to Ohio. Ohio House Bill 515, which allows you to take the business income deduction on the sale of your particular entity. Here's one that may apply, well, it'll apply to all of us. This is an issue that's gotten a lot of press recently. If you're going to be buying or inheriting farmland, some people are really zeroing in on taking a portion of that purchase price or inherited value and allocating that to what they call excess nutrients. It's an aggressive tax strategy. So in other words, when you buy a property, you're going to allocate the tax basis to several different components. The land, maybe some on the tile, maybe you've got some buildings. Another allocation could be on excess nutrients. There's very little in the tax code that's going to give you an allowance to do this, but there's nothing in there that says that you can't. Okay? There is one memorandum that does give us a little bit of guidance. The safe strategy here is if you're going to be buying a property, you can look at the records of that previous owner, look at their P&K applications for the last year, maybe two, and take that as a separate tax basis and then expense that amount. The more aggressive strategy is to take the maintenance levels, whatever the fertility experts say in your state, and anything above those P&K maintenance levels, you can take that as a separate tax basis and deduct that over a number of years. Question?
Okay, so if you've been previously farming the ground, so you were paying for the input,
Yeah.
and you just recently inherited it, does that make a difference?
If you've been farming, no. Just because you farmed it, no.
Okay.
It shouldn't. If you inherited that property, then of course you're going to have a step up in basis on the whole property. But according to what we've been hearing, and we've been following this closely, I just met with several colleagues, including some from Iowa State and Minnesota, about 2 weeks ago. And some of these, there's some agencies that are very aggressive going out there and trying to sell this to certain farmers that are inheriting or buying property. It's, again, if you choose either method, it's considered probably an aggressive strategy. The Minnesota Department of Taxation is the only one that we know of that's been aggressive in oversight on this. We haven't heard anything from Indiana, Ohio, Iowa, as far as those state departments of taxation. But I think if we see more and more of this start to be used, I think our state departments of taxation are really going to take notice. What the Minnesota Department of Taxation is requiring is those people that are taking this and taking this excess fertility and writing it off or expensing it, they're requiring them to show an actual drawdown in that fertilizer amount. So you're going to expense it, you better show that you're actually moving that P&K level down to those maintenance levels. All right, so this is something, if you haven't already seen this, you probably are going to hear more. Flexible cash farm leases, some of you already have these. Cash lease with a bonus approach is pretty common. Percent of gross income, pretty common. This is not as common. You know, I've had a lot of requests here in the last couple of years, especially because prices have gone higher. That triggers higher rental payments on these percent of gross incomes, but input costs have gone right up with them. So the net really hasn't been enough in some cases to pay for some of those higher rents as a result of this particular flex lease arrangement. I just wanted to show you, I've got several that people have shared with me over the last 2 or 3 years because it's always really difficult to get those percentages. You know, that's another negotiation piece also. You know, corn acreage, 25% of gross, beans, 30%, probably on the low end. Here's a base rent and the bonus. Corn acreage, you know, here's one based on soil type. This is a lot more complex, flex lease, percent of gross revenue. There's a number here, 27%. This is actually one of my brothers. He's got one of these, 27% of gross, using his own selling price as that average. He didn't feel comfortable, and the landowner was agreeable not just to use a third-party set of price points to come up with that price component, but using his own selling price. There's another page here that might be useful to you. I'm not going to go through all these, but a percent of net, that requires a lot of communication, a lot of trust, opening the books. It's almost like a crop share lease, but it's not. But my estimation, and the ones that I've talked to some growers that have been in one of these, 40 to 45% of net back to the landowner is probably plenty. But it can protect you in the ups and downs. And right now, we all know it's a very aggressive, not only farmland value and purchase market, but also rental market as well. All right, here's my website. Most of my information you can find on our farm office page. Here's my contact information. And then also, we do a monthly, myself and my colleagues, so this is including farm management, farm economics, and ag law subjects. You can join us on our monthly farm office live webinar. This is free. We'd love to have you join us. Okay. So here's my contact information, and I'll try to answer a question or two. I know I'm up against my time limit probably. And I know we bounced around, and I tried to probably put you to sleep on the interest rate thing. Maybe I need to move that to the end, perhaps. I'm still working this out. This is about the 8th time, I think, that I've given this in about the last 2 weeks, so it's a work in progress still.
Back on fertilizer,
Yeah,
when we was prepaying,
yeah.
they said, well, just hold off on fertilizer.
Yeah.
We'll write you down and get back with you. I haven't heard anything. What should we,
Oh, as far as timing, you mean?
yeah, to get it done? Is it just gonna keep going down, just pay?
Oh, that's the big question that I've been wrestling with. I've got that question over the last couple of weeks. There's some softness in the marketplace right now, and whether the question is timing, whether that will continue. I wish I had a concrete answer for you. A lot of the fundamentals that I covered lead me to believe that we're not in for a big spike. In other words, not a big movement higher. However, you know, the entire northern hemisphere is still going to be in the market for fertilizer as we go into the spring period. I don't want to pin myself down. I can get myself in real trouble here as far as suggesting it's definitely this, and if you take my advice, you're going to be out a few $100,000.
Did suppliers, as costs were higher going into winter, did they fill?
Some did, yeah. So they have some of that higher priced product in their pipeline at the retail level. So you know, we don't always see those New Orleans prices and our local prices change on a one-to-one basis. So yes, there's some of that still in the pipeline. However, it's going to be difficult for them, especially as these prices trend a little bit lower, to hold prices at those higher levels when you've got the river pretty close. You know, that's one of the things that you have here. At least you've got the river market, which is you know, just transportation costs from New Orleans to keep things a little bit more honest. You know, with all the indicators that I'm seeing, and with the lower trending energy costs, that I don't see, unless we were to see a much higher or much worse winter in the latter half that's going to spike natural gas prices. I really find it difficult to believe that we're going to see large upside with fertilizer markets. Now, there may be a slight upside just simply from the spring demand. Yeah. Did I leave myself a lot of wiggle room on that? I hope so. It's difficult. Yeah, I know. It's what we do. It's tough because you guys are making decisions with lots of money, I know.
You talked about river transportation. Is it getting back to normal now?
Well, with the lower Mississippi River levels, I think it's helped a little bit over the last couple of months, but there's still, I think, from the last I heard, there's still restrictions. You know, there's still, it's not back to normal levels. So that's an area of concern, obviously. Any other questions? It's been my pleasure to be with you, and I'm going to leave a few of these surveys. I'm going to stick around through most of the morning to hear these gentlemen talk about grain markets, but if anybody's willing to share their per unit price on average for their farm for a bag of seed corn or a unit of soybeans, I'd be happy to take that data. This just allows us to kind of, I guess, ground truth our budget data, and also if you're willing to share what your average herbicide costs are on a per acre basis on both corn and soybeans. We would love that data, and hopefully that wouldn't compromise you in any way. So, okay. Thanks a lot, guys. We appreciate it.